Welcome, guys, to another episode of the WealthWise Show. I'm your host, the Wise Investor, and here today we're going to embark on a hopefully wealth-wise journey of monetary policy. Just to get a couple of housekeeping things out of the way. Make sure you guys understand that this podcast, everything I say, anything that is mentioned here is for educational purposes only. Please do your own research when it comes down to investing, and make sure you talk to your personal financial advisor and investment advisor for finding out what is best for you and your needs. Everything I say, any companies I mention, any tickers, anything like that, they're example purposes, educational purpose only, and my opinions on the markets and a company or anything like that are exactly that, my opinions. So with that being said, let's enter today's show of monetary policy. And the reason why I wanted to talk about monetary policy, because, the past couple of weeks, we talked about the different economic data reports that comes out. We had another one come out this week of the core retail sales, and it came in a little bit higher. And so, what does the core retail sales, the CPI, and non-farm payroll, and even the unemployment claims has in common? Is they pretty much show a nice picture of what's happening with everyday folks. So if you look at non-farm payroll, if that report comes in high, meaning we had a lot of jobs increase for that particular month, then that means more people are working. So that means if CPI comes in and CPI comes in higher, well, that means more people are spending. And sometimes not necessarily they're spending, but majority of the time it's because they're spending. There's a lot of spending happening. There's a lot of demand, not that much supply. And then if you look at the core retail sales, if those come in as high, well, that correlates with the CPI and the non-farm payroll where, well, people are spending on retail things. Um, then if you look at the unemployment claims, if those come in lower, well, that means not a lot of people are unemployed. Majority of the people who are working, you know, they're actually working, not filing for unemployment. So those are pretty much some of the, and I would say the most important, but probably the most important right now reports, data, economic data reports, because people are, running around trying to figure out, hey, what the Fed is going to do. Are they going to raise rates? Are they going to pause rates? Are they going to cut rates? And majority of the time, you know, like I said in the last couple episodes, common sense is something that I'm trying to use this year. That means if these economic data points are a one-off, all right, then I don't see the need to, think for the Fed and change their plans. If these economic data comes in and it's continued to trend in a certain direction, well, that's something different. Now I'm going to start, making, uh, you know, plans, not changes, but just plans. I've already made contingency plans for if this happens and that happens. It's called a bull case, a base case, and a bear case. So I've already made different plans for different scenarios, but those plans can change. All three of those different plans can change depending on what the economic data comes out and says and tells me personally. And so, with that being said, monetary policy has to deal with the way the feds control the money supply, you know, and these reports help influence their decisions. And so these reports usually come out before they speak. So if you are a do-it-yourselfer investor, or you're someone who's, you're not really into the markets, but you find economics interesting because it directly affects you, then knowing what these reports comes out, if you hear it on the radio or you see it on the news, or even you look up the reports yourself, you can see how things may change for you in the near term, depending on what the report says and monetary policy. So, understanding monetary policy is extremely important. Why is that important? Because that's how the Fed or which is our central bank, that is how they control the money supply. Well, what is a central bank? So, very, very simple term. A central bank is the country's bank. So, the bank of the country. You can't bank there. I can't bank there. But other banks who are in the country can bank there. And other countries have central banks. And so, think of the central bank as, of the bank, the bank for all banks. And so that's pretty much what that means, what a central bank is. And the U.S. central bank is the Fed. The reason why that is important to understand, because when you hear, oh, the central bank or the Fed is doing X, Y, and Z, then it's going to trickle down to you eventually, well, whatever they're doing. And so when it comes down to monetary policy, which is something that the Fed use to help control the money supply, to help keep price stability, stable, that's what their goal is. They want to make sure high unemployment, or I wouldn't say high, but they want to make sure that the unemployment rate and the inflation rate is, they're stable. They want to make sure enough people have jobs and enough people is still having jobs to afford things. So when you look at monetary policy, there's a few aspects of monetary policy. And the three tools that they normally use when it comes down to monetary policy is where is it? It is the open market operations, which is, the interest rates, reserve requirements, um, and the discount rate. So open market operations, interest rates, and reserve requirements. Today we're going to tackle. Let's see. We'll play by ear. I want to tackle one in each episode because I'm lazy. Well, I'm not actually lazy, guys, but I do want to stretch out because after this, I got to figure out what to make next week. Because if you don't know, I'm making this day off, so this is fresh, no stale content here. So I might just go with one at a time until I can figure out what my plans are. And so, open market operations is one of the many tools that they use. And the reason why this is market operations, or I'm just going to say OMO. So, open market operations is in abbreviated form is OMO. So, if I say OMO, that's what I'm saying. The reason why OMO is important because that is how the feds can directly affect the money supply. I mean, like, you know, when they say the Fed is printing money, and I got this from a video from um, Crash Course. When they say the Fed is printing money, they're not like actually out there creating new dollars per se. Even though they do, actually print money, but they're not actually out there creating more dollars. What's happening is they are purchasing or selling debt securities. And so you might say, well, what is a debt security? Well, we've talked about this in numerous videos, numerous episodes. I've mentioned how debt securities are bonds, essentially. And bonds are effectively loans that you're loaning to a government or corporation, and they pay interest. And so, how does buying or selling debt securities, how is that, you know, how does that directly affect the money supply? So a few episodes ago, I talked about businesses and how businesses, um, you know, if it makes sense to pay off a loan early. I talked about how when countries own the debt from the other person, why they don't just pay it off. And the reason why is because now, let's say you do pay off thing. So the same thing with the OMO. If the feds were to sell or buy, their debt securities from these banks. Because remember, the central bank and banks only do business with each other. Like I said, me and you can't go there and get an account. So if this bank, let's say Bank A, owns $1 million in bonds that they're collecting interest on from the government, like government bonds. So if the Fed wants to interject cash into the markets or interject cash into, you know, the consumer stream, they will buy those bonds from Bank A. And how does that interject cash? Well, if I own some bonds and I'm collecting interest, and then the government says, here's all your money back early, or here's all your money back, and you still get to keep the interest, but here's all your money back. Now I just have a bunch of cash. They pay me back all my money. So now that I have all this cash as a bank, I don't want this cash just sitting here because it's in my custody. It's not really collecting interest like that. So what am I going to do? Well, I'm going to go give it to my depositors. Hey, you want to open up a line of credit? Do you want to open up a loan for this mortgage? Do you need a second mortgage? Oh, hey, do you need a new car? Now you're going to get all these flyers and pamphlets of saying, hey, 0% interest for X amount of time, or low to something percent interest for X amount of time if you come borrow this cash. And what happens when the depositor, which is me and you, go get those loans and go get those lines of credit, we'll go get that, things like that. Well, we go and take that money and we spend it. And what happens when we spend it? We spend it with another company or X, Y, and Z, and now things are growing. And so that's pretty much what OMO does. It interject cash, but it can also take out cash. Well, how does taking out cash works? So if I know that if I'm buying your bonds is going to mean you're going to have excess cash for your depositors and things like that. Well, guess what? I'm going to sell you bonds. The interest rate is probably going to be nice. Like right now, interest rates are high. So I'm going to sell you these bonds and you're going to, have less cash. So now that you have less cash, we have this interest, you're still happy because you're still making money. But what you're not going to do is go to your depositors to try to, you know, use your reserves and get them to go and loan in and all that stuff. You're not going to do that. So if you are not doing that to your depositors, what's happening with your depositors? Well, they're not being offered loans, they're not being offered lines of credit, and they're probably not going to be, have the incentive to go out and make those big purchases like auto mortgage and or auto real estate and things like that. And so those are pretty much what open OM up OMO. That's pretty much what they do with that particular tool. Uh, Typically, the reason why the Fed would interject money is if we are in an economic recession, like a really bad recession, like '08, for example. I know that's a big one to go back to, but there are plenty of other examples. Like 2020 was the most recent example, where you know, hey, things are getting pretty bad. GDP is not doing what it needs to do, and we need to get the people moving. We need to get the economy roaring again. So hey, interject some cash into the system. Buy back all those bonds. Buy debts or buy back mortgage securities because a lot of times they buy mortgage backed securities. So buy those, and now these banks have all this extra cash to go do what they want. So when they say they're printing money, that's pretty much how they print money. And then the opposite happens is where, hey, the economy is great and it's roaring and it's like, everyone has jobs, people are, going on vacations, Instagram is popping, and, you got too much fun going on. And that's going to increase the inflation because if, like I said in the beginning, if the demand is high, but the supply is low, well, that's going to raise prices. So OMO is a great tool. And reading from Investopedia, they're not a sponsor, but they are a great resource for when you're trying to, if I'm saying something that you just don't know, like, what does that mean? Well, Investopedia got your back. The definition that they put out is, well, it's not their they put out, it's the definition, but they, has it for me. So the Federal Reserve policy of buying and selling U.S. Treasury securities along with other securities on the open market in order to manage the money supply is the definition of open market operations, OMO. So now you know something that, you know, can, I'm not sure how it's going to help you in your everyday life, except talking at the water cooler. But, you know, now you know. And so, with that being said, I'm going to end today's episode mainly because I have nothing else planned. And it's 9 o'clock, and I got to get some work done. So, I'm going to try to um, continue to do what I'm doing currently. The videos. If you're listening to this on Spotify, if you're listening to this on Apple Podcasts, if you're listening to this on iHeart Media app, or anywhere where you're listening to this podcast, I have a YouTube page, The WealthWise Show. And here you'll see video. The video is not that great because I'm using Zoom to record it. And I think my camera is like 720. But this is the start. So, bear with me. And if you're watching this on YouTube and you're like, hey, this don't look that great. Yeah, well, you can always go to Spotify. Go to Spotify, go to Apple Podcasts, go to iHeartMedia app. I think I'm even on Amazon Podcasts or something like that, where you can, listen to it and not see my face. And share with your friends. You know, go ahead, and if you find this information interesting, if you find it helpful, if you find it wealth wise, I don't know, go ahead and share with your everyone. So that's gonna be it, guys. I appreciate the listens. I appreciate the support. And next week we'll see what happens. So until next time, guys. Till next time, guys. Stay wealth wise.